You haven't seen an effect of tariffs. I think that's an extraordinary amount of complacency.
What is going on with Jamie Dimon and what's going on with markets? Because so far, everybody's just buying the dip. Retail bought the most stocks ever at the stock market open yesterday, and for the first 3.5 hours, or you could say 4 hours before 12:30, we saw the largest buying by retail shareholders that we have ever seen in the history of tracking retail buys between market open and 12:30 Eastern time, that 4-hour window, the largest by a massive magnitude. It seems like people basically researched the whole Moody's drama and were like, all right, every time we have one of these credit downgrades, they end up being a buy the dip. So, well, let's buy the dip. That's exactly what happened yesterday with the S&P 500 and the Qs going from negative 1% each to positive. Retail really just does not give a flying F about selling right now, and the idea is buy, 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 which in fairness has been working really, really well. There has been no broad concern, and we've even here on the channel been talking about using trailing stops as a tool for maximizing the gain and minimizing potential downside, and so far it's just been straight up since we've been talking about those in mid-April. Small caps, in fairness, are seeing the largest outflows out of all of the various different funds that we could look at, whether we're talking large caps, medium caps, small caps absolutely getting hosed with a cumulative negative $68 billion, the largest outflow ever in a year to date, and then again for small caps. But if everybody is so bullish, then what does Jamie Dimon see that's bearish? Well, first, he says credit risks today are really bad. And not only are credit risks bad, but asset valuations in America are very expensive. And he says that the people who are buying right now are people who haven't been through a real downturn. I think he's basically trying to cast aside COVID and the tariff dip as not real downturns. And I think he's thinking back to like a dot-com bubble or even a great recession where we had massive unemployment combined with a serious downturn and a very slow to react fiscal and monetary system. In other words, Congress and the Fed were kind of slow to react, unlike what we've seen over the past crises, especially COVID. So Jamie Dimon says that trade and this sort of tariff war that we're going through is creating a lot of risks that we just haven't seen yet. And those risks may take time to come. He says there's an extraordinary amount of complacency and that we are on the fringes of extremes, considering that even at the lower levels that we have now for tariffs, we're still at extreme levels we haven't seen in decades. In fact, a blanket 10% on all countries hasn't been seen since 1971. And if you combine all of the tariffs that we now have on global trading partners, we have the highest tariffs since the Great Depression. So Jamie Dimon sees stocks selling off by at least 10%, but he's not so worried about that 10% because we just had that in April and got through it. Big deal, right? But he actually thinks that the resulting credit crunch could hurt Americans even more. So what I wanted to do is sort of compare this to what's going on over at SocGen. And SocGen gives us a little bit of an idea of, okay, how are these tariffs, like when are we actually going to see tariff impacts? But then TS Lombard says something crazy that just flips the tariff script, and I want to show you that right after I just take a quick look at this. Dang, look at that. Since the open, it's a little volatile there at the open, but it's basically been straight up on D-Wave. We'll talk about them soon, but wow, this was one heck of a call in the Alpha Report. Another call I had in the Alpha Report this morning was that Tesla stock would not stay above 347. It's written down in black and white in the Alpha Report. And Elon talked at the Bloomberg conference, which we'll talk about later as well, knocked the stock up over the line, but look at what happened. Right back under and ceiling. But you know what I like to say? When we're sort of boiling up under one of those lines, it's just a matter of time to potentially explode through it. Unless, of course, we get to buy the rumor, sell the news on that robotaxi event. Anyway, these are some of the things that we talk about in the Alpha Report every day. Make sure you're part of it. If you haven't joined yet, go to meetkevin.com. Take advantage of the coupon code that we have for Memorial Day. When you lock in that price, you lock it in forever. So it only goes up from there. And your price will not go up. You'll lock it in forever. Okay, so SocGen tells us that American asset prices are high, but the big risk that we should be facing or concerned about is actually when the tariff momentum hits. And they believe that we may not see sizable weakening in overall economic momentum until mid Q3, which basically means mid-August. They say that Beijing is likely to withhold significant increases in stimulus in the meantime, although I did write in blue here that China did yesterday lower their lending rate by just 0.1%. It's still over 3%. But you're seeing a little bit of loosening, but not really a lot. I mean, they could get a whole lot more aggressive with stimulus. And I think SocGen is right to say that they're kind of just waiting right now to see what plays out. But they do say that assuming no change in future tariff levels and a more modest stimulus support, they're actually revising China's GDP up. Now, this morning in the Course Member Live, we actually went through trip.com and found that they're pretty optimistic about China travel and seeing more international travel come to China than they have previously seen. That said, it is possible that labor market and tariff dynamics could hit hard in that August timeframe. Take a look at this one. U.S.-China negotiations could still collapse and derail. Obviously, that's always going to be a risk that negotiations collapse. I don't see that as so concerning. But what I do think is more impactful is that they say the current level of tariffs are likely sustainable for China. But they don't say that about the United States, suggesting basically that, China got a really good deal here because even though we got this 90-day pause, the level of where Chinese tariffs are now is acceptable potentially to the Chinese, but could still really hurt the United States and the global market. In fact, they say the easing of U.S.-China tensions has put the U.S. economy in a sweet spot for now, with financial stresses potentially to reemerge in the third quarter, again, July, August, September, as we get to the ultimate level of tariff deals or assignments, as Trump has talked about. And labor market dynamics will be key to watch, while negative wealth effects and falling real incomes will hit consensus for stock forecasts, of which we're not seeing right now. In other words, markets have been pretty optimistic and potentially even a little bit blasé about the potential for earnings per share write-downs. And I think that's what Jaime Dimon is frustrated about as well. He's like, man, people just really aren't paying attention to the oopsie-doopsie that could be coming. But, oh well. When we take a look at what T.S. Lombard has to say about this, they have a really interesting note. And it's sort of like, wow, is this what happened to the Federal Reserve? Maybe. So take a look at this one. On the positive, okay, so they're talking about charts for inflation, and they're also referring to an article from the Federal Reserve. And they say, the Fed says that the impact of tariffs has been obscured by other price movements, which have declined to offset tariffs. Put another way, U.S. inflation would have been even lower without tariffs. Central banks just love a counterfactual, don't they? Okay, let me translate this. If it weren't for tariffs, we might have been in deflation, and the Fed could have cut. So in other words, tariffs basically made it so that the Fed didn't have to cut to stimulate us because we were in deflation. Instead, tariffs just brought price levels up back to sort of an acceptable wait-and-see level, and so tariffs are basically duly responsible for keeping rates higher for longer, which makes sense if we assume that tariff pricing has already hit, which T.S. Lombard says to some extent we've already seen tariff pricing start coming through. SocGen says, nah, not so fast, wait until August, because that's when the poop really hits the fan. Who knows, but it's kind of interesting because, as usual, it means bonds got the short end of that stick. Oopsies! In the meantime, though, Home Depot and Walmart both reaffirming their fiscal guidance for the year. Home Depot sees growth of 2.8%. They see the economy getting through the sort of Q2 bump. And even though Walmart didn't provide Q2 guidance, Home Depot is. And their stock's up today. Markets are kind of happy with the earnings. Operating margin guide came in a smidge lower, but Q1 sales came in a smidge better than expected on a dollar volume basis. Though comp sales missed a tiny little bit. Remember, the difference between that could be the opening or closing of locations. Anyway, gross profit at Home Depot, 33.6%. Net profit of 8.6%. So that actually brings some decent money down to the bottom line. That said, a lot of people are wondering, is the economy just being propped up by BNPL services? So Klarna is a service provider for both Walmart and Home Depot. And the Financial Times just reported that Klarna's net loss doubled to $99 million for the 3 months ending in March, which is nearly $400 million annualized and more than double the losses that they had last year. Customers failing to pay has risen by 17%. However, if you look at this sort of on like a total losses in terms of dollar volumes, they're only at total losses of about 0.54% versus 0.51% last year. So the dollar volume level isn't up that high. It just seems like more people might be defaulting, but dollar volume wise, the defaults aren't actually that substantial. I personally think the losses are why Klarna wanted to IPO quickly to get access to equity markets and kind of help fund those losses. But I do think it's also possible that, Klarna just wants to kind of IPO at a peak. And Walmart and Home Depot might be able to get through the 2025 drama in part because of Klarna. So you're kind of changing market dynamics in a very interesting way where maybe you can sort of like basically borrow your way through a recession and then you don't actually get a recession. The question though then becomes, okay, when does the bill finally get paid? My guess is probably never. Or the stock market will just absorb those losses. And you're sort of like socializing BNPL debt. Very interesting. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield plus you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the Househack website because there is risk with every investment.